All right, everybody. Give me a second. Hopefully, those of you that are watching this are also noticing my pin post. This should be a good conversation with Seth Cogswell. He actually upgraded his camera because he figured, you know what, he's going to be a media star now, so he's got to up his game visually. The good thing is that he's handsome. Unlike me, I need to have filters, and I did fasting apparently. If any of you want to engage during this roughly hour-long conversation, doesn't matter what platform you're on, X, YouTube, LinkedIn. I can see your posts. I can see your comments. Let's make this as interactive as possible. We're going to be talking about stocks, outlook for next year, a little bit about Seth's background, and maybe some year-end thoughts, because who knows? Things might still get a little bit volatile. We'll see.
Yeah.
We'll get into that. So with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour roughly is Seth Cogswell. This conversation is sponsored by Seth's firm, Running Oak. They've got a great ETF, RUNN run, which we can touch on as well. But Seth, I know about you. Plenty of new people listening in for the first time. Who are you? What's your background? What have you done throughout your career? What are you doing now?
You asked me the same thing.
I'm very basic, man. I'm very basic. You know, the trick is you got to say the same thing 500 different ways.
I love it. Well, that actually, it messed me up last interview because I generally avoid talking about myself whenever possible. And so I'm used to answering the question, tell me about Running Oak, or tell me about your strategy, or tell me whatever. It really threw me off when you said, tell me about yourself. And luckily, being the professional that you are, you were able to, cover up my missteps and just move along.
I think you are. I know you're intelligent, but to call me a professional is a little bit of a stretch.
Well, something. I mean, certainly better than I am.
Okay, I'll grant you that. No, I'm kidding.
Yeah. So our strategy is rules based, which means it's really designed to remove us from the process. It's designed to remove our discretion and our emotions, and so for me, I think that's one of the biggest positives. And because it removes us, it's definitely not about me, and so I generally avoid talking about myself. That doesn't mean I still talk too much, but I try to avoid talking about myself. And so that, again, that question threw me off slightly, but as I thought about it more, it actually is about me. This has been a learning process, and it's led to me actually realizing that, you know what, I need to be able to answer this question, because Running Oak is me. I took a 99% pay cut to launch it. I basically mortgaged my family's future to get to where we are today, which has led to a lot of stress. I've worked my butt off for 11 plus years to grow it however I can. And it's also a result of the experiences, my life experiences leading up to the launch of Running Oak, and also the last 11 years. So it very much is me. So I decided I need to actually embrace that question.
Can I say something? Because I think this is actually interesting for the audience. A little bit about sort of the fund world, right? So you're a portfolio manager, and I often make this point that in the fund world, whether it's a mutual fund or an ETF, if it's rules-based, you're really more of a product developer rather than a portfolio manager, which is important because it does separate out let's call it the person from either the problem or the success, but the person still has to communicate what those rules are.
Correct. Yeah, and not only that, it'd be one thing if I had created the strategy and the process, but I didn't even do that, right? I mean, my father created the strategy and the process in the 70s and has been running it since. It was basically given to me. I look at it as though I was handed a golden ticket, and it's really up to me to help it reach its potential. I see myself as more of the steward of the strategy or the firm, which is not especially sexy. I don't look at myself as this portfolio manager, badass or anything like that. And so again, there's the 3 Ps of anytime somebody's doing due diligence or talking strategies, there's the 3 Ps, right? It's like, I'm going to actually mess up the 3rd P, but it's because I'm never in that position, but it's one of the Ps is people. And it's always awkward because I don't want to talk about myself, but I'm actually going to still not talk about myself for the most part, but I am going to tell a story because I think it does provide a really good sense of running oak of myself and hopefully inform investors or future clients. So again, my father created the strategy in the 70s. I grew up kind of looking over his shoulder. That was pre, 80s, early 90s, that was pre-computer. So my father would receive these stock chart books. There was one that was blue and orange. And I would steal them and then like comb through them and imagine how easy it would have been to buy low and sell high. And that got me very interested in stocks. So the moment I had a few $100s in college, I set up a brokerage account and bought a very hot stock tip from a kid who it turned out had no business giving anyone hot stock tips. It declared bankruptcy within a week. It was literally the worst stock tip ever.
Hold on. Okay, hold on. So on that stock tip, did you what was the conversation like after that? Like, were you still friendly with that person?
We weren't even really friends. I don't even know. I don't think I put much thought into it. And it's funny. This actually, we could take this later on into a discussion about passive, but I didn't think about what I was investing in. And so I didn't have much money. I worked hard for this money and then I invested it without thinking, which is crazy. But that's what I did. But I learned a very valuable lesson. I learned, first of all, I should probably vet my sources. Clearly, I didn't vet that one. But two, I should probably actually learn what I'm doing. And so I went on to read every single book I could find on the markets and stocks. I just lived in the library and looked through newspapers and did whatever and continued to trade. And so I'd run, as soon as math class was over, I'd run to the computer lab and put in some trades or something. I was definitely trading, not investing. And I did well. So at some point, these numbers are going to be they're inaccurate, but you get the trend. I started with $500. And at some point, I think, let's say senior year, I was managing, or not managing, but I had like $12,000. And so I had done well. And I had some friends. I was actually just texting with two of them. I had some friends who had some money saved up and they had invested, and almost every decision they made destroyed value. And so they were like, they asked me to manage their money for them. And the deal was that they would give me 20% of what I made, and I would pay them 20% of what I lost, which was my rule because I knew I'd feel guilty if they lost money.
Oh, hold on. So this is literally, it's like a prop shop. It's like the economics.
Yeah. Like my own little thing when I was 22. And so I agreed to give them, or I didn't agree, I insisted that I would pay them 20% of what I lost. And I wasn't worried about it because they didn't have that much money. I continued to do really well. And at some point, the father of a friend found out and asked me to manage his money. He had a lot more money than my 22-year-old friends. It wasn't so much that I was concerned about my ability to kind of backstop it. But so I agreed to do it. And so I continued to do well. At some point, I think my $500 investment grew to, again, these numbers aren't perfect, but let's say $35,000 to $40,000. And I did well with this, my friend's father's account as well as my friend's. He got excited and doubled or tripled the amount that he had invested. And I called him and I was like, that's too much money. I can't backstop this. And he was like, well, I'm putting it in there and you can decide whether you want to invest it or not. It's not my choice. I'm just putting the money in there. It's up to you. And, I was 22, I was dumb, felt like I was invincible because at that point I had just been killing it for a few years. And so of course I felt the need to invest it. And unfortunately, soon after I ran into one of the most challenging periods of my life, one of the most difficult. And one of the kind of series of books that I loved when I was learning about the markets was called Market Wizards by, I think it's Jack Swagger. And it's interviewing.
By the way, not to interrupt, but so I've interviewed Schwager in the past, and
don't tell him that I screwed up his name.
Yeah, and I will say that Yeah, those are always like go-to books for me personally as well, right? Just the interviews and sort of
They're awesome.
the strange quirkiness of some of these supposedly legendary traders. I only say supposedly because I had asked Jack this question before. He actually never really verified the performance.
Right.
That's a whole different discussion.
That's really
We'll
funny.
leave that for another podcast. But anyway, good.
So one of the major trends or kind of prevailing themes in his books was do not trade when you're emotional. It's hard enough to make high stakes objective decisions. It's another thing when you're a mess. And I was a complete wreck. And so I ended up in I think a matter of a month or maybe a little more, I turned my $40,000, which took me years to build up, into zero. I went from 40,000 to zero. And my friend's dad, luckily, I was taking a lot less risk, but I was taking a lot of risk to get those kind of returns. And, he lost a good amount. I guess he maybe had too much confidence in me, so he didn't pull the plug, which would have been nice. So eventually it came down to me to pull the plug, which I did at some point. And when I did, I owed him a lot of money. So what I did is there was a bank or a credit card company that made the foolhardy decision to lend me $25,000 at a 0% APR. And so I got this credit card, I maxed it out, and I sent this guy a check. And that was it. That was the end of my self-made kind of prop shop. But why this really matters is I see this as one of the most defining moments in my life where it was a nightmare. I mean, it's hard to imagine more going wrong. I had $0. And, I was able to find the kind of strength to do what was right, despite how much it scared me. And again, I think running Oak is me. And this was one of the most formative experiences of my life. It's one of the things that I'm proudest of. And I think it's an aspect of running Oak. We will do whatever we can to benefit the client. That doesn't mean that we're perfect. Market's going to go up and go down. But we will always put the client, our clients, and their well-being first, which I think differentiates us. There's a lot of very large companies in the investment management industry which are dominating flows simply because they are big. But they're very low. There's not much to them other than they're like a vacuum cleaner. I don't think that they're really putting the client first, whereas we are. The other takeaway I would say is the rules-based nature of our strategy really appeals to me following that experience, because that's the purpose of it. The purpose of the rules-based process is to ensure that that doesn't happen, to ensure that our emotions are not negatively impacting how we manage the portfolio and our clients. And so again, there's nothing better than learning from other people's mistakes. I've had some hard knocks, and ideally running Oak can help clients avoid those.
I will say that point is underappreciated, because a lot of people in our industry, as you know, throw the term around fiduciary. And there's a difference between being a fiduciary and being an asset gatherer. Yes, they can overlap. But for the most part, fiduciary, which is supposed to be about looking out for your client in the best interest of your client, for the most part, that's really not what I would argue a lot of advisors do. They're just asset gathering. They're doing standard traditional asset allocation. They're not really caring about markets. They never read Schwager's books. They never had the intellectual curiosity. They are not rules-based. It's hard to get that message across when I think the vast majority of the industry is exactly like that.
Yeah. I don't know. I think in the end, it's a people business, right? I think particularly for advisors, I think a lot of it just comes down to we can't be the best at everything. We can try to be our best at a handful of things. I think advisors, the true benefit that advisors provide their clients is that relationship. It's helping them kind of think through things. It's helping them hopefully hold their hand, because life can be challenging. The market doesn't always go straight up. I realize it's basically gone straight up for the last 15 years. That just means that it's highly unlikely to not do so in the not too distant future. But investing's hard, and if you're working hard and you're putting money in the market, that's investing. It's difficult. And I think advisors, it's that relationship. That's the value they add. Now, whether advisors can best serve their clients in investment management ways, I don't know. Like, some might be really good at it. It's just really hard to like dedicate. I mean, investment management is a full-time job, and many investment managers aren't even that great at it when they're doing it as a full-time job. So I think for an advisor to both focus all their attention to provide the best possible service for their clients, let alone try to grow and actually prospect, and manage portfolios, particularly picking out individual stocks, I just think that's very difficult to do.
All right, so I get the rules-based. I'm a huge fan of rules-based as well. I share a similar dynamic to you in that sense. The strategy is product is different than the product developer who's named as the PM. Let's talk about, so you built out the firm, you're doing separately managed accounts. Talk to me about the types of strategies that you've used firm-wide, presumably more than just what you're doing with Run. And then what got you to even launch the fund to begin with?
Well, firm-wide, and actually I think this is an interesting differentiator versus a lot of other firms, as we do one strategy. We've only ever done this one strategy. I spoke with someone a little while ago who I really like, and he made the comment that he kind of wished he had launched some other strategies, just because you never know what's going to be, in favor at that moment. Our strategy has been out of favor for basically the last decade. Fortunately, it's still performed really well. I generally think that no good data point should be left unsaid. And so our strategy, despite being out of favor, still top 1 percentile in our space, which is mid-cap core. And it's performed relatively, it's basically performed in line with the S&P over the last decade, despite minimal exposure to the Magnificent Seven. So it's been a hard road, but we have continued to only run one strategy. And it's because I have, running Oak again is May, and I have absolute conviction that the way that we manage money is one of the best possible ways to achieve long-term compound growth for clients. I just, anything else that we would provide, I don't think it would be as good. And that's largely driven by, we have real-time data going back to 89. And over that period, it performed, it was in the top half of a percentile of all US managers as far as risk and downside return. And I just don't, it's tough to beat top half of a percentile.
Like everything else, there are going to be times when a rules-based approach works and times when it looks like it's not, right? There's always cycles to everything. So you're going to have periods of outperformance, periods of underperformance. Over time, cumulatively, obviously, you hope the outperformance swells the underperformance. Were you ever tempted in those times when it looks like it's not really synced up or working for whatever reason? Were you ever tempted to kind of rethink the rules or change things up? I say that because I've seen that, and I think it's a mistake when quant managers are bending the knee to clients who are saying you have to change up the way you're investing because it's not performing right now.
I have had very little negative feedback over the last 11 years. There's only one client that's kind of been a little challenging, and it was largely with regard to realizing gains. They just really didn't want to tell their clients that they had taxes. But if our strategy, I mean, again, it's performed in line with the SP. The SP's up huge over the last decade. So that means we're up huge. But over the long term, I would expect our strategy to outperform the SP by 3 to 3.5% or so. If the SP's up on average, we're up more. There's going to be gains. And I think one of the biggest, I would say that the main value that we offer is our sell discipline. That's where many managers and individuals struggle. You get attached to something. That sell discipline means that we are going to sell things when they become of value. Again, that's our big value add, but it means there's going to be gains and it means there's going to be taxes. Now, that is one of the huge benefits to the ETF, that at least enables our clients to kick the gains down the road until they decide to sell the ETF, which ideally they never do and just donate it. But that's one of the areas where I've ever gotten feedback. Otherwise, and maybe I've been sort of lucky. The last decade was, I think it could always be worse, maybe our worst nightmare. Our sell discipline, which again, I'd say is our most valuable value add, or that's our main value add, is effectively anti-momentum. We sell companies when they become overvalued, when they go up a lot. We also, one of the ways in which we look to protect to the downside is to avoid companies with too much debt. Over the last decade, companies have taken on more debt than any time in history, and largely for no other reason than to buy back stock. They didn't add more value, they just simply bought back stock. That is also, or avoiding debt and kind of fighting that trend is also anti-momentum. And then lastly, our portfolio is equally weighted, which puts mean reversion in your favor, but is also anti-momentum. Meanwhile, a few months ago, momentum hit the 99.8th percentile in history. The only time that it was even close to the last, to the last few years was the tech bubble. So in the hottest period in history for momentum, we've been sitting here anti-momentum, and we've still performed in line with the S&P. Now, if we had struggled quite a bit more and we had maybe people were becoming impatient, that would have been a different story, right? Then you're watching, this business that you've worked to build kind of start to dwindle, and being disciplined is very hard. There's going to be times where I would say over the long run, there's no arguing that it's not good to be disciplined. But there's gonna be times in the short run where you're sitting there watching everybody party and you're feeling a little lonely.
Yeah, I think that's very well said. I wonder, since you mentioned the tech bubble and at 99.3%, whatever the number was, you yourself, do you think that we're in somewhat of a, maybe not bubble, but some sort of a mania phase that could be due to reverse pretty aggressively?
I would have said that a while ago.
No, that's the problem. I know.
So I think that we were definitely in an everything bubble, particularly in 2020, 2021, or right before COVID. Tech had been absolutely insane leading up to that, and then all of a sudden it just kept going up more and more. And it was doing so while word was coming out that China was closing down, and still stocks were going straight up. It was also when debt had negative yields. I think there was no arguing that we weren't in some massive bubble. And you could also look at real estate. It's extremely difficult to afford at this point. I mean, I'd say it's basically just completely unaffordable for many. So whether I'd say it's a bubble or not, I don't know, because there's going to be a lot of people to argue with me. But I do think that things are out of control, and it'll be interesting because there's a lot of similarities to the tech bubble and today. One of the big differences is in the tech bubble, the stocks that kind of led the charge were largely unprofitable. That was definitely a little bit more of a mania. Whereas today, the stocks that I would say are the most crowded trade, the trades where you have the most indiscriminate money going into it, is the big tech stocks. Now, those are very profitable and they generate a lot of cash. So it's very different from the tech bubble, but it'll be interesting to see how it plays out, because the popularity of passive over the last decade or two means that a lot of people have indiscriminately just been investing a massive percentage of their net worth in a small number of companies. And again, I think the most important part of that is indiscriminate. There's no major decision that you make in life where it makes sense to not think, but that's what's been going on for quite a while. And that's usually when you experience a bear market, it's when that poor behavior through the bull market and people getting ahead of themselves, the bear market is where that is wrung out. And again, the big tech companies, they've been the biggest recipient of that behavior. So I would expect the bear market to punish them more than almost anything.
You know, like about equal weighting, you alluded to the mean reversion point, but it's the purest form of factor investing, right? Because it's not based on idiosyncratic aspects, market cap weighting on momentum. It's, every one of these stocks fits that criteria for whatever factor that you're tracking, and on average, it's a good representation of that dynamic. You mentioned the mid cap core-ish side of things. Talk to me about the construction of Run. How many positions? What type of sector allocations are there? And can it conceivably be more of a core allocation as opposed to mid-cap satellite, let's say?
Yeah, so our universe is companies with market capitalizations of $5 billion and above, which is mid-large. We then sort out companies with that are expected to grow at the highest rate we can possibly find. But then we're very disciplined. We then call that down based on valuations and some other risk metrics. It's always going to be mid-large. Again, we've got data going back to 89, and the portfolio will always be walking the line between mid-large. I wouldn't describe it as a mid strategy. It's probably more of a, I don't really love using the word all cap, but anytime you constrain your decisions, you want to make sure you're doing so for the right reasons. We constrain our market cap at $5 billion because as you go lower, I don't think you can argue against the fact that you take on more risk because there's less liquidity there. The companies are smaller. And so we do have that constraint there for a reason, but otherwise it's largely unconstrained, other than the process is there to guide our investment to consistently invest in companies that have the qualities that we seek, which is as high earnings growth as possible, but avoiding overvalued companies at all costs, and then investing away from qualities that lead to greater downside risk, such as I mentioned earlier, debt. Now, as far as sector exposures, again, the portfolio is equally weighted. We're completely indifferent towards sectors, but Value Line breaks the market up into 99 different industries, and we do invest. We make some kind of allocation decisions based around those. We want to make sure that we have significant diversification. So we generally have more than 30 industries represented. We'll cap any one industry to 13 to 15%. And so the end result is you get an equally weighted portfolio that's diversified across companies and industries, really with the goal of minimizing that idiosyncratic risk. I would say, since we're talking about mid-cap, there was something I wanted to show you.
Yep.
Assuming I can, I haven't used this.
We are live, folks. That's what happens when you're live.
All right, here we go.
Let's see if that shows up. Don't see it yet on my end.
Technology.
It's fun. The nice thing about this is that this is all going to be edited out, so nobody's going to know this is actually happening on the podcast.
We can always come back and revisit it. Let's see.
I do think that I like the way you define things. I like like I said, the rules-based approach, and again, you've got the results. So here we go.
Sharing?
Yep, you're good.
Nice. There we go.
See?
Next time
he's a product developer. He knows how to. He's got a great camera. The guy's a rock star. Come on.
I'm coming. It's a work in progress, but at least it's progress. So I think this is probably, if I were going to stress the one thing that I would want to tell people today, or the one thing I really want to get out there, is this. I have been, as the firm's grown, with the launch of the ETF, we've had more and more conversations with the largest firms, which is enabling me to get a much better sense of how the largest firms are allocating clients, or maybe even just the biggest trends. In the past, we worked more with independent investment managers or investment advisors. So, there's a little more nuance. We would see, kind of smaller windows into what people were doing. As I've gotten a broader view, it's something really interesting has become obvious, and it excites me because I think we work perfectly with it. But as much as I hate investing around the style boxes, I think the style boxes can be really helpful for getting a sense of where your exposure lies. So if you start out with the traditional style box, every allocator, whether it's investment advisor, the big platforms where they approve strategies, they all have large cap. And because of what has happened, because of the dynamic over the last 10 years, a large percentage of most large cap strategies are mega cap and big tech. Now, that could be a result of just simply performance, or it could be a result of the only way for most managers to keep up was to go overweight those big tech companies, and many have. But if you use SCHG, which is the Schwab Growth Portfolio, as an example, and that's something that I see a lot of clients invested in. So I think that's a good representative of this large cap growth portfolio. 51% of SCHG is in 8 companies. Over 50% is in 8 companies that are highly correlated. So this little mega slice that you see is probably actually a lot smaller. It's highly concentrated at the very top end. Now, so people think they're getting large cap, but they're not. They're most of their exposure is up at the very top end. That large cap exposure is then balanced with SMID. So the issue with there aren't many pure mid cap strategies. Last time I spoke with Goldman Sachs, they didn't have a single mid cap strategy that was approved on the platform. Most of the platforms I talk to have SMID. And if you're walking the line between small and mid, you're probably going to end up in, kind of concentrating around your midpoint, which is going to be the larger part of small, the smaller part of mid. And that leaves that upper mid part largely uninvested. That mega and SMID exposure is then complemented with value. So these are kind of like the 3 very obvious ways in which many of these platforms and advisors allocate clients. Is you've got growth, value, SMID, large, and value might overlap a little bit with SMID on the mid-large side. But what you see is this leaves a huge gap in a client portfolio. You can see it. It's this massive gap, and we not that creatively, but there's a lot of ways to play on it. So I like it. We have called it Marge, which is just mid-large. I'm sure plenty of other people call it Marge. It's not all that creative. But regardless, it's this sweet spot that is wildly underinvested. When I look at the large platforms, when I look at advisor portfolios, people think they're getting large cap exposure. They're largely getting mega. People think they're getting mid cap exposure through SMID. They're largely getting the smaller side of mid. And this Marge area is exactly where you want to be right now. So you mentioned we would discuss maybe year end. So this touches on that. The most important dynamic in the market right now is interest rates. I would imagine most people would argue that. After the Fed cut rates, they did a jumbo cut in September. Interest rates went straight up. The whole point of cutting rates is for them to go down. And so they went up. They cut again, and they didn't go up much, but they've come down a little bit recently. But the main thing is, who knows what's going to happen with interest rates? Because the Fed's cutting rates, they're going up. There's no telling. It's an uncertain time. If rates continue to go higher, that hurts SMID because those companies are smaller, they're more interest rate sensitive, they had less leverage when they negotiate terms. I think 50% of the Russell 2000 is actually zombie companies, maybe, certainly unprofitable. So if interest rates go up, that's going to hurt SMID. It won't impact mega very much because they generate a ton of cash. They did have a lot of leverage and they got great rates. But it also won't impact Marge very much because Marge they're again larger companies. They're not quite mega, but they're close. And particularly as far as run or efficient growth goes, we intentionally avoid companies with a whole lot of debt. So higher interest rates will not impact, will impact Marge less and will impact efficient growth or run quite a bit less. Now, if interest rates go down, interest rates generally go down for one reason, and that's because we are in a recession. Usually the Fed's famous for being late. If they're cutting rates, they're probably a little concerned we're headed to a recession. If there's a recession, SMID, while lower interest rates will benefit SMID, a recession definitely won't. They're much more economically sensitive. That'll be difficult for smaller companies. Mega, on the other hand, as we talked about before, a bear market, which generally coincides with a recession, a bear market is where the excesses of the bull market get wrung out. Many would argue that the excesses are most concentrated in the big tech companies. That's where an insane amount of money has been indiscriminately just invested constantly. That is where the most pain probably lies if we do end up in a recession, because again, that's where the excesses are wrung out. That means that companies go back to fair value, but the problem is they don't stop at fair value. They usually go flying right through. So again, if interest rates go down, big tech's probably going to really struggle. SMID will struggle. Marge, on the other hand, there's a reason why we're invested there. It's because of that gap. Nobody's investing there, which means there's less dollars chasing these companies. It means that the valuations are more attractive. And so if these companies did not participate in the excesses, why there's nothing to be wrung out. So you could see a scenario. Now, this is, I wouldn't say it'd be this extreme, but in 2000, you had a handful of companies that got wildly overvalued. And when the market went down, those companies went down. But there were a lot of companies that didn't participate in the excesses of 2000. So you had value and quality, and our portfolio were actually up in 2000. I'm not saying if we see a recession, we'll be up or those will, but again, that's a good example where if things did not participate to the upside, why should they participate to the downside? Certainly not. Certainly they shouldn't to much extent. So again, I think this gap, if I just go back, I would just recommend that many clients, many advisors take a look at the actual holdings and where they lie. From what I have seen, this space is completely underinvested. And for those reasons, as far as interest rates, whether interest rates go up, whether they go down, whether we have a recession, whether we don't, this is the place to be.
Yeah, you got to be curious. I was going to say, show me the next slide, because that is,
Actually, I do.
Yeah. Let's go into that. And by the way, I agree, and it makes sense, the underinvestment, because to your point about the passive side, right? All this money's been flowing into large cap, market cap weighting and left a lot of things largely for dead. So there should almost by definition be much more opportunity because there's fewer players betting on that payout, right? On a relative basis.
Yep. So this is a client sent me this last week, actually. What you can see is, so this is measuring.
Just present again. I don't see it on. Yeah, click present again. Yep. Seth was good at technology, but no.
Well, I'll be quicker than I was last time.
Yeah, no, so good. Listen, I always enjoy listening to the way that you frame things. I told you this before. I think your approach is spot on.
My wife doesn't always appreciate how I frame things.
Hopefully, she's watching this video.
Not at the moment. Are you able to see this?
Yeah, you're good. Yeah.
Okay, great. So this actually perfectly supports all that I just said. A client of ours sent this to me last week. And what it illustrates, so the top is large cap. As far as like the Schiller kind of CAPE index, what you see is that P's currently are way beyond the median for large cap. in small cap, they're actually marginally overvalued or marginally above the median, which kind of surprised me. Mid cap, on the other hand, is undervalued or below its median, which is crazy. If you think about how, the market goes up, has gone up a lot, both recently, but for the last decade. It's easy to think that everything is overvalued, but according to this chart, that space, that marge space, is not overvalued right now. Large cap, at least relative to its long-term median, is wildly overvalued. Small cap is marginally overvalued, but mid cap is the place to be as far as valuations go. So again, just another, this really supports that that kind of marge discussion in the fact that this space is the place to be. You, in the long run, you want to be buying assets at attractive prices.
I love that you're all in, right? Meaning it's on the SMA side, it's on the ETF side. I'm always reminded of a great line that diversification is a luxury for the rich, and if you want to get rich, you've got to be all in, right? On your business, on whatever it is that you're doing. For advisors or individuals that are looking at RUNN, your fund, typically, what do you find? Do people allocate 5%, 10%? Is it a larger portion? Do they typically wait to see the large caps go down and then allocate? Talk to me about sort of the things you're seeing in terms of the actions taken.
That's a timely question. That's actually going to be the topic on my next newsletter, because it's something I've thought a lot about. We found that with the SMA, if somebody's going to invest in the SMA, it's kind of it requires a little more work, right? You've got to create accounts. And so because there's a little bit more work, people are either all in or they're not. And so our largest SMA clients actually use our strategy as 15 to 20% of their equity portfolio, which is how I would argue to use it, because it walks the line between growth and value, mid and large. So it really is that I would use it as that sliver in mid and large in blend or core. I think that's the sweet spot for it. And the fact that it's performed so well just means that, you've got a little extra invested in your best idea. Now I'm saying that my strategy is your best idea, but again, I didn't create it, so I can say whatever I want and not be bragging. That is how our largest clients use it. That's how I would recommend using it. That's how I would use it if I'm building portfolios. What we found with the ETF, though, is it's so easy to invest in that people are not necessarily all in or not. There's, I think, probably, from what I know, let's say there's 60 teams or advisors with an aggregate of, let's say, 100 million invested in RUN, but their aggregate AUM is probably $100 billion. And so they've got less than 1% right now invested in, which is very different from that 15 to 20%. Even if you use it as a mid-cap strategy, that would be, let's say, 5%. So that's below that. And that's something that I've been struggling with and trying to figure out. I think part of it is it's so easy to invest in that you don't have to be all in or not. You can dip your toe in and see how it plays out, and I understand that mentality, although it doesn't fit my mentality. If I see something that I think is the best, I'm in. But that's definitely something I'm struggling with. So if anybody would like to provide feedback on how to best communicate how to use our strategy, please let me know, because that's again, that is going to be my topic of the next letter, is really, if you're not investing in your best ideas and you're not investing in the strategies that are situated to perform the best, you're going to end up basically performing in line with the market. I mean, if you invest you're effectively sort of closet benchmarking. There's a lot of firms I see where they've got 30 strategies that are, make up their overall portfolio. And that does reduce risk to a certain extent, but it also means that you almost have maybe market risk. So it actually, I mean, if you're really disciplined and invest in strategies that really guard to the downside, but then you dilute those, then you might actually be taking on more risk by investing in more managers.
Very well said. Seth, for those who want to learn more about Run and maybe learn more about the RIA, where would you point them to?
Runningoak.com, runningoaketfs.com. Also feel free to email me at Seth, S-E-T-H, at runningoak.com. We would love to talk to you.
And now, like I said, Seth's got a killer camera. So as you can tell, you'll see him in full HD. Appreciate those that watch this live. This will be an edited podcast under Lead Lag Live. Again, this is a sponsored conversation by Running Oak. I'm a big fan of Seth's, and hopefully I'll see you all in the next episode. Appreciate it, everybody. Cheers.
Thanks, Michael.